Yeah, so we can start. So today we're going to look at the distinction between a company, or distinction of a company, distinction of a company from the other forms of business, from the other forms of business, So distinction between a company from the other forms of business. So when we introduced company law, so we explained what is a company, and I was able to indicate to you that a company is a form of business or a means through which one can be able to carry out business. So it's just a form of business amongst the other forms of business you might end up having to know. So like in this case, maybe a sole proprietor, or in this case, maybe a partnership. Like in this case, maybe what we refer to as what a cooperative society. A cooperative society. So we are going to distinguish a company from all the three. So how different is a company from a sole proprietor? How different is a company from a partnership? And how different is a company from a cooperative society? How different is a company from a cooperative society? If you happen to be joining our class for the very first time, I've already been able to share the notes. So I'm not going to dictate the notes here. So take note of that. So you can just take short notes as we discuss, as we move on like that. But what ideally I'm going to discuss here on the board, I've already been able to provide the notes. So it's not a matter of having to dictate the notes, but I'm going to teach you understand. I'm going to teach you understand, not dictating notes. I'm going to teach you understand, not to dictate the notes. So you just need to maybe take short notes if you're in an environment where you can be able to take the notes. So of course you might be assuming everyone here is seated somewhere just comfortably listening to this class. But I was also a student, I know. So there are those who are on their way going home. There are those who are multitasking. So there are those who are having to cook. They're checking whether the ugali is ready as they hop into the class. People are doing a lot of things. So you just listen in as you do your own things there. You can take short notes as we proceed. So we are going to distinguish a company from all these other forms of business. And for my students, I normally advise them, if you want to distinguish these other forms of business, there is something that in this case you just have to be aware of or to get to know. You have to know the features or the characteristics about these other forms of business. So once you've been able to know the features or characteristics about these other forms of business, then it becomes very easy to distinguish with a company. Because for a company, we've already been able to learn the key features about a company. It is a separate legal entity, can own property in its own name, can contract in its own name, can exist into perpetuity, can have a limited liability, can sue or be sued in its own name. It will, in this case, transacts by having to utilize its common sale. It comes into existence through incorporation. We've already been able to learn about the features of a company. So therefore, for us to be able to distinguish a company from these other forms of business, quite important that you just understand what are the features of these other forms of business. Then you end up having to compare. If you have a feature this side, is it having to exist that other side of a company? And as a result of this, you'll likely be able to do what? To distinguish. For example, if you talk about a sole proprietor, what are the features of a sole proprietor form of business? Features or characteristics of a sole proprietor. Features of a sole proprietorship. Features of a sole proprietorship. These ones I know you know about them. You can give me like 4 or 5. You can give me 4 or 5. You can give me 4 or 5. Easy decision making. So Mary Ann has just given us 1. Very brilliant. Easy decision making is one of the key features. Easy decision making. Which is the other one that you can be able to mention? Easy decision making. I can see one of my friends having to say, it is owned by one person. Wow. In fact, that was supposed to be the first one. Owned by a sole person. Owned by a sole person. It is owned by a sole person. You enjoy profits alone. So the owner enjoys profits alone and suffers losses alone. So owner enjoys profits alone. Owner enjoys profits alone. Enjoys profits alone. And also does what? Suffers losses alone. Suffers losses alone. You people have given so many answers. That was from Benedict. 𝐻𝐿 is having to say not a separate legal entity. Indeed, it is not a separate legal entity. It is not a separate legal entity like a company. It is not a separate legal entity. Very brilliant. Very brilliant there from 𝐻𝐿. I can see Kiki says unlimited liability. Yes, unlimited liability. So there's in this case the aspect of what? Unlimited liability is still just emanates from the principle of separate legal entity. Unlimited liability. Unlimited liability is another key feature about a sole proprietor. Unlimited liability. I can see Deborah says lack of business continuity. It emanates still from this one. Lack of business continuity is a feature that emanates from that. Lack of business continuity, indeed, it happens here. Lack of business continuity. Lack of business continuity. What else? What else? Less legal formalities. One of our friends has told us less legal formalities. Less legal formalities from one of our friends there. Flexibility in operation. Jen says flexibility in operation is very correct. Flexibility in operations. Flexibility in operations. Which other one might we be forgetting? I can see Deborah says depends on capital from savings and borrowed funds. Yes. How do you raise capital? How do you raise capital for a sole proprietor? So the capital is from savings. So the capital in this case you need to formulate or to form in this case a sole proprietor. So source of capital is savings and borrowings. You can be able to borrow. You can borrow from your relatives, or maybe your friends. So your father, your mother, your sister, your brother. So they can give you some money. Then in this case, eventually you can set up what? A sole proprietor. I can see Kundu says there is no ultravirus. So the principle in this case, ultravirus. One man control, so exactly owned by a sole person. So this happens to be part of the key features about, in this case, a sole proprietor. So if you look at each and every feature, then you try and actually compare with the other side of a company, you won't end up having to miss, in this case, what? A distinction or a difference. A distinction or maybe a difference. Like when you start with this one here, where you're having to say that the source of capital, it is savings and borrowings. When you go to the side of the company, the major source of capital is actually, in this case, what? Share capital. And of course, in this case, what? Debt capital. That is already a difference you've already been able to formulate there. So while in this case, for a sole proprietor, the major source of capital can be savings or maybe borrowings from friends or maybe relatives. But now in this case, the other side of a company, the main source of capital would be share capital or debt capital. So we'll learn these ones later on as individual topics. So you don't have to start asking a lot of questions about them. You'll get to understand them. When you talk about share capital, it is where the company sells shares to raise its capital. When you talk about debt capital, is where the company does borrowing, for example, by having to issue or sell out an instrument we refer to as a debenture. That is already, in this case, what? A difference. When you go to easy decision making. So it is very easy to make decisions in a sole proprietor. The reason being, the business is owned by a sole person. He doesn't have, in this case, to consult a lot when he's having to make decisions. But in the case of a company, the business is owned by shareholders. Before any decision ends up having to be made, they must be able to converge at a company meeting, which will later on, in this case, learn to be known as what? A general meeting, and they approve some of the resolutions. As it might be that far much easier to make a decision in a sole proprietor, it cannot actually end up having to be that easy because in a company, because the company is owned by many shareholders. Many shareholders. So by the time so many people end up having to agree, it can be time consuming. Time consuming. That is already a difference. It is owned by a sole person. It is owned by a sole person. For the case of a company, we said, if it is private, the membership or the ownership is how many people? If it is private, the membership or ownership is how many people? If it is private, the membership or ownership is how many people? Abdallah. You need to say something, Abdallah. Abdallah, you need to say something ahead. I can see Jazz says 0 to 50. I can see Shakim says it is 1 to 50, not 2 to 50. I don't know why students end up having to confuse. A private company can be owned by one person, but the maximum number is actually what? 50. So it is 1 up to 50. Then if it happens to be a public company, it is a minimum of 2. What about maximum? If it happens to be a public company, it is a minimum of 2. What about maximum? It is unlimited. So there's no maximum. So that is correct. There's no maximum. So if it's a public company, minimum number of owners or shareholders or members can be 2, but there's no set maximum limit. If it's a private company, 1 up to 50. So that is in this case what the limit in a private company. While in this case, in a sole proprietor, the business is owned by a sole person. That is already a difference you've been able to get. For a sole proprietor, it is owned by one person, while the other side of the company, it is a private company, can be owned by 1 up to 50 persons. It is a public company, can be owned by a minimum of 2. And there's no set maximum limit in terms of membership. You can see how the differences are just having to arise. They're just having to arise. So it's not a matter of, in this case, you having to cram. Point 1, a company has a sole person, while in this case, no, you don't have to do that. You just have to remember the features. What are the features about a company? If it happens to be private, these are the features. If it's a public, these are the features. What are the features of a sole proprietor? If I try to compare these features, is there any form of difference having to arise? It will, of course, in this case, end up having to do what? To arise. Because this is one of the questions that in this case might end up having to come in the exam. They can either ask you to, in this case, mention the differences, or they can ask you to mention the advantages, or they can ask you to mention the disadvantages of one over the other. Like the question could go like this in the exam. What are the disadvantages of operating as a sole proprietor other than as a company? What are the disadvantages of having to operate as a sole proprietor other than a company? What do you need to remember? The features. Look at a feature. Does it, in this case, give rise to a disadvantage, or it is an advantage? Like when you talk about decision making, easy decision making, this might end up having to be far much advantageous on the side of a sole proprietor, because the sole proprietor can actually be able to make decisions very fast. But if it is on the side of the company, it is a disadvantage. And therefore, this one is an advantage over the side of what? Of a company. Over the side of a company. When you talk about membership or ownership, so companies can actually be owned by so many people, and therefore it gives room to even raise more capital, because these owners, they'll bring in capital. So the source of capital for a company will be wider compared to, in this case, what? The source of capital of a sole proprietor, due to the fact that a company can be owned by so many people, so many shareholders. So they'll bring in capital, as in this, they subscribe to the capital of the company. That's very important. Just remember what? The features. If you go to this one, the owner enjoys profits alone and suffers losses alone. What about the side of the company? What is the difference? On the side of the company, profits are shared amongst the shareholders in form of what? Dividends. In form of dividends. So if you are a shareholder in a company, you normally get what? Dividends. If all of us are shareholders in Safaricom, we'll share into the profits of the company in form of dividends. While if he's a sole proprietor, he enjoys the profits alone. If there are losses, he will suffer them alone. But in the company, the profits are shared amongst what? The shareholders. If it happens, there is no profit to share, they won't get any form of what? Dividends. So they'll also, in this case, what? Suffer all of them. They will suffer all of them. So the losses in the company are suffered by all the members. So that happens to be what? To be a a difference. But now if you look at it critically, this one is like an advantage over a company. Just imagine if you are in a business, you are enjoying the profits a lot. So it's an advantage over, in this case, a company, because you can see the company, they share into small portions, 2 shillings per share as dividend. While here you made your 60 million per year, that is your money. You're going to eat it alone. You're going to eat the money alone. You're not going to eat with anyone. So that happens to be like an advantage over the other one. But the difference you're having to say, in the side of the company, on the side of the company, profits are shared amongst what? The shareholders. While here, he enjoys alone. All right. In this one, you're having to say it is not a separate legal entity. While for a company, it is a separate and distinct person from the shareholders or the owners. As a result of this, the emanating features or characteristics about a company then end up having to also bring about what? Differences. Like we said, some of them you people have been able to mention here. Like when you talk about liability, so you talk about liability. When you talk about continuity, one of our friends mentioned continuity, yes, business continuity. So there are emanating features here about a company which will not actually end up having to be on the side of the sole proprietor. Like we have what? Perpetual succession. Perpetual succession. We have ownership of property in own name. Ownership of property in own name. Ownership of property in own name. We have being sued, sue or be sued in own name as a company. It doesn't happen in a sole proprietor. We have what else? Ownership of property, sue or be sued, perpetual succession, the aspect of limited liability. The aspect of limited liability, contracting in its own name. Contracting in its own name. All these ones emanate from this what? Principle of separate legal entity. So while in a sole proprietor, we do not have the principle of separate legal entity, in a company, we do have it. And therefore, these features do what? Arise. So if you talk about contracting in its own name as a company, the side of the sole proprietor, it cannot actually contract in its own name. If contracts are entered into, it's like they're entered into in the name of the owner of the business. When you talk about business continuity, in the case of a company, we do have what we call what? Perpetual succession of ownership. And therefore, it can exist forever and forever. While in a sole proprietor, if it happens, the sole owner dies. In case of death, the business might end up having to come to an end. So there's no continuity plan here. Here there is, because there's actually what? Perpetual succession. Ownership of property. If it happens, a company has acquired a property, it will be registered in the name of the company. The ownership will likely be in the name of the company. It doesn't happen in a sole proprietor. It's like those assets or properties that have actually been acquired, they will be in the name of the sole owner. Can sue be sued in its own name? So if there's actually any court action against the business, in the case of a company, it will be in the name of the company. It doesn't happen in a sole proprietor. It's like the owner of the business would have actually been sued before the court of law. In the case of a company, we can have, not all companies, but most companies or majority of the companies are registered as limited companies. And therefore, there's usually the aspect of limited liability. We discussed so much in our previous lesson about limited liability. So it means in a company, not always, or in this case, in most of the times, we can end up having to say that there's no way your property as an individual owner of the business in a company can be attached to pay off liabilities of the business. But in a sole proprietor, if it happens, that business cannot actually be able to service the liabilities, then the properties or assets of the owner can be attached. So there's no what? Limited liability. So there's no limited liability. This our friend has told us here. Unlimited liability. But it can exist on the side of the company. It can exist on the side of the company. Flexibility in operations. Yes, there's of course flexibility in operations. There's of course flexibility in operations in a sole proprietor. Today, you might actually be selling what? Pairs of shoes. You can just even wake up tomorrow and say, I'm not selling pairs of shoes. I want now to change. I want now in this case to start operating another form of business. Because the scale of operations in a sole proprietor, rarely they likely be at a large scale. It is very flexible in terms of even having to do what? Change the operations. But in a company, you realize the operations might end up having to be a bit complex. They might end up having to be a bit complex. And therefore, it can become very challenging very challenging to change what? The operations. So while in the case of a sole proprietor, there's flexibility in operations. In the case of a company, sometimes they can be difficult, or majority of the times they can be difficult in terms of change of operations because companies operate at a large scale. Operate at what? At a large scale. At a large scale. And those happens to be part of the differences that might end up having to arise when you're talking about the difference between a sole proprietor and a company. So we can be able to mention another one. If you look at a sole proprietor, because of the nature of its operations, for a sole proprietor, there is what we call what? Personal customer touch. This is what we call personal customer touch. Personal customer touch. Personal customer touch. Personal customer touch. There is personal customer touch. Like that guy having to operate a kiosk. That guy having to operate a kiosk hapo mtaani. Huyo jamaa anaoperate kiosk hapo mtaani. Huyo jamaa anajua customers wake wote. He knows all the customers. Kuna wale wakuja kukopa deni na wanalipanga. Wengine walipangi, anaandika kwa kitabu, anaandika kwa kitabu. No problem. So they pay end month. So no problem. He knows he'll end up having to pay. So he can be able to interact with them. He's the owner of the business while he's interacting with them. There's that personal customer touch that is there. So he can be able to ask them, how have you been? How was your day? Then he just appears there. He tells them, today, mambo haikuwa mzuri. It was not that okay. So what you do, give me 2 packets of unga. So my family cannot actually, in this case, stay hungry. You know how we normally do it. So I just come and actually pay at the end of the month. So you can see they are able to interact. But in the case of the company, just imagine, all of us here, 112, we are shareholders at Safaricom. Have we ever interacted with our customers at Safaricom? We haven't. We've just put directors there and the employees. We've told them we are just sitting back, relaxing at home. We are waiting for that dividends at the end of the month. Yet we are owners, yet we are shareholders there. So there's lack of that customer touch by the owner of the campus. Owner of companies, you might end up not having to even interact with what? The customers. That in this case are customers of your business. But this one is actually enjoyed in a sole proprietor because he's the one who participates in having to, in this case, do what? Run the business. So he's able to interact with the customers like on a day-to-day basis. But you as a shareholder in a company, you're just sitting back, relaxing at home, waiting for dividends at the end of the year. In this case, don't know what is having to happen with the customers. You've given the mandate to directors there at Safaricom to manage the business, to bring for you, in this case, what? Dividends at the end of the year. 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 So that happens to be another difference. There are others. We can actually be able to mention them. The others we can be able to mention them. We can be able to mention them. If you look at the case of a company, of course, some of these ones we'll actually be discovering them along the way as we do our studies for company law. If you look at the case of companies, if they are public companies, they are under mandate. They are under mandate to prepare and publish. Books of accounts. They are under mandate to prepare and publish books of accounts. Public companies are under mandate to prepare and publish books of accounts. But if you are a sole proprietor, it is not mandatory that you prepare and make your books of accounts public. So it is not actually mandatory to do that. But if it happens to be a public company, for public companies, under the Companies Act, it is a requirement. That you ensure each and every financial year, you actually make sure you prepare your books of accounts and you publish them. You make them public. You publish them and make them public. Another one, I don't know why you never gave me this one. It is easy to keep secrets. It is easy to keep secrets in a sole proprietor. Easy to keep secrets. It is easy to keep secrets, because you're the one having to run the business. You are the sole owner. So people might be assuming you are making millions in that business, but you're the one who only knows. Mazee, hii busy yangu hata kuna kitu napatanga. But assuming you are making millions of money. So you can, in this case, keep that secret, because you are the only one who knows where the shoe is having to pinch. No one else is having to participate in running the affairs of the business. You run it as a sole person. But for a company, it is not easy. It is not easy. It is not easy because we have so many shareholders. So it means if there's actually any information pertaining to the company, you can't assume you can end up having to keep the secret. Hakuna siri ya watu, tuseme watu wawili ama watu wangapi. Hakuna siri ya watu wawili. There's no secret for two people. There's no secret. Once the other person has known, then just assume it has already been known by everyone. So you can't keep that secret any further. So, but in a sole proprietor, because you are the sole owner, it is very easy to keep what? Business secrets. But in case of a company, not easy because most of the companies will end up having to be owned by more than one person. And therefore, part of the secrets of the business might end up having to leak out there. Those happens to be part of the differences between a sole proprietorship form of business and a company. Let's look at a partnership. And see what are the key differences having to arise when you talk about a partnership. What are the key differences that arise when you talk about a partnership? This one about a sole proprietor, you have to be very keen. You know, there's a sitting we were looking at, we are expecting that they are going from topic 1. They're going to set very difficult questions. They're going to ask us the difference between a company limited by guarantee and limited by shares. We thought they were going to bring that. They were going to bring lifting the veil of incorporation. They're going to bring that one. So that in this case was our assumption. We were assuming that is what is going to happen. Then surprisingly, in a particular setting, they just asked, what are the advantages of a sole proprietor? Question number 1A. 8 marks. 8 marks. So mark you, most of the students were only remembering 5. Five. So you have to be very keen with such kind of areas. So don't actually, in this case, forget to remember them. So like features of a sole proprietor. And in fact, that question, I think it has been tested like twice. If you check your past paper twice, it has been there. They talk about Benedict has been running this kind of a business. What are the features of this kind of a business, which is a sole proprietor? So you have to list all those features. So they can ask, what are the advantages of having to operate as a sole proprietor? You just have to remember the features. Then from the features, you can actually be able to indicate what is the advantage having to arise. So take note of that. They can ask such kind of simple questions. Features of a partnership. Then we see how are these features different from what we know about companies. The first feature here, these partnerships are usually regulated by the Partnership Act. These ones are usually regulated by the Partnership Act. Another key feature that you have to take note of regarding partnerships are usually owned by two up to 20 persons. If it happens, it is in insurance or banking business. If it's insurance or banking business, then it is normally 2 up to 10. 2 up to 10. That is the ownership of a partnership. Number 3, there is no principle of separate legal entity in a partnership. No principle of separate legal entity. So of course, when I mentioned this one, then remember the emanating features about separate legal entity won't exist here. So like when you talk about succession, when you talk about ownership of property, it cannot be in the name of the partnership, it's in the name of the partners. When you talk about contracting, it will not actually be the name of the partnership, it will be in the name of the partners. So there is no principle of separate legal entity. And as a result, the emanating features about this particular principle here don't exist here. And therefore, they bring about what? The differences. The ones I had actually mentioned here. Contracting in its own name, ownership of property in its own name, perpetual succession, so like that. So they won't actually exist here. Then also another feature about partnerships that you have to, in this case, be aware of. Their source of capital. Their source of capital. How do they raise their capital? Source of capital. Their source of capital is from partners' contributions. Partners, maybe it is normally from partners' contributions towards the capital, partners' contributions towards the capital. What is the other key feature about partnerships? You realize with partnerships, in most of the instances, the partners will participate in management of the affairs of the partnership. So partners take part. Partners manage the affairs of the partnership. The partners will manage the affairs of the partnership. The partners will manage the affairs of the partnership. What is the other key feature you have to take note of regarding partnerships? Number 6. Number 6 about partnership, what you also have to take note. Of course, there are those who have actually been able to learn about what? Most of you have been able to learn about public finance and taxation. The tax burden in a partnership is normally on the individual partners. The tax burden in a partnership is on the individual partners. On the individual partners. Hata mimi najua tax kidogo ya juju. So the tax burden on partners is normally on the individual partners. Once you've been able to calculate the profit of the partnership, then you normally do something we call what? Appropriation. You normally do something we call appropriation. Then after you appropriate it, you do what we call profit share. After profit share, then now you tax the individual partners. Then number 7, another key feature. So the one we talked about, not under mandate. They are not under mandate to publish their books of accounts. To publish books of accounts. They are not under mandate to publish what? Their books of accounts. They are not under mandate to publish their books of accounts. Not under mandate to publish their books of accounts. Not under mandate to publish their books of accounts. So if you look at all these features, you'll see some difference that is having to arise. Look at this first one here. Kiki. Look at this first one here. Regulated by the Partnership Act. While for the case of a company, regulated by the Companies Act. Regulated by the Partnership Act. While for companies, regulated by the Companies Act. Look at this one, Rosemary, look at this one. Owned by 2 up to 20 persons. If it happens to be a partnership in insurance or banking business, normally 2 up to 10. While for the case of a company, if it is private, 1 up to 50 persons. If it's a public company, a minimum of 2. No set maximum limits. Look at this one. No principle of separate legal entity. All the emanating features now bring about what? A difference. There is perpetual succession in a company. In the case of a partnership, there is no perpetual succession. In case of death of a partner, unless in the partnership agreement it was stated, the life of the partnership is likely to come to an end. In case of acquisition of properties, they likely be listed in the name of all the partners. But in the case of a company, it will be listed in the name of the company itself. There is the aspect of limited liability in the case of a company. In the case of a partnership, there is no aspect of limited liability, so like that. Although we can be able to have special kind of partnerships, we call them LLP, or limited liability partnerships. So those are partnerships that have like elements of a company, but they're not in this case fully companies. Just the aspect of limited liability now makes them to look like what? A company. Where in this case, the liability will be on the individual partners if it happens to arise. Then the source of capital for partnership is actually the partners end up having to contribute what? The capital. They contribute the capital. In the case of a company, the company can sell shares and raise what we call what? Share capital. Or they can be able to borrow. The company can borrow and raise that capital. For partnerships, in most of the instances, it might even not be all of the partners, but some of the partners might take part in the management of the affairs of the company. For example, if there are doctors who have ended up having to set up a hospital, so there is one who's having to deal with what? A particular specialization area in terms of medicine. So you'll be dealing with that area. There's another one, another area. So they will take part in the management of the affairs of what? The partnership. In the case of a company, the members or the shareholders will appoint directors. They will appoint directors. We'll learn about the topic of directors way later on. It is topic number 8, where we will say directors of the company are the ones who oversee the overall management of the affairs of the company. They are usually appointed by the members or the shareholders of the company to run the affairs of the company on behalf of the members. In a partnership, they do participate by themselves. They do participate by themselves to manage the affairs of the partnership. In the case of a partnership, the tax burden is on the individual partners. In the case of a company, it is in the form of corporate tax, which is direct, which is actually direct on the profits of the company. It is direct on the profits of the company or the business itself. But here, once the business has made a profit, they have to distribute it first of all, before KRA or the taxman comes in to tax the individual partners, In the case of a company, the tax burden is on the company itself, the profits of the company itself, in terms of what we refer to as what? Corporate tax. What we refer to as corporate tax, it is normally 30%. So you'll end up having to pay it as an installment tax. So they spread it. They, like in this case, spread it. Then it is not under mandate to publish its books of accounts or financial statements. In the case of a company, if it happens to be a public company, it will be under mandate to ensure that its books of accounts have actually been published. Those happen to be part of the differences between a partnership and a company. So same case, if they ask disadvantages, remember the features, then look at this feature. Does it sound like an advantage or a disadvantage? So once you have the features, some of them you can actually be able to pick them either as a disadvantage or as an advantage, because that is what the examiner will end up having to call upon you to explain. State and explain 4 advantages of a partnership over a company, 8 months. So what you need to remember, the features. Then look at the feature critically. Does it actually sound to you like an advantage or a disadvantage? Some of the features, of course, depending upon your argument, they might fall in both. Depending upon, in this case, how you'll argue with the examiner, they might fall in both. You can see it from a different perspective as having to be an advantage, or from a different perspective as having to be what? A disadvantage. Having to be a disadvantage. So like that, like that. Those happens to be part of the features of a partnership. Adjust the board. So this is a 𝐿𝐴𝐿 is asking me to adjust the board. You are the boss. Let me do it for you. You are the boss. I don't know whether you're able to see now. 𝐿𝐴𝐿. It is okay now. Yeah, it is okay now. There are audit firms that are not partnerships, so they operate as LLP. So we call them limited liability partnerships. These are special kind of partnerships that have elements or some features of a company. They have elements or some features of a company. So they call them LLP. So professional firms nowadays like operating like this, as a limited liability partnerships. So we have like 3 individuals who become partners in an audit firm. But now when a liability arises, then in this case, each and every individual partner can end up having to bear the liability. Or there are some liabilities that in this case, they'll likely be borne by the partnership itself. They likely end up having to be borne by the partnership itself or the audit firm itself. So like if you have the 3 partners, so the 3 partners having to run the affairs of what? That particular audit firm. So in auditing, you learn something we refer to as auditor's liability. Sometimes a liability can befall you as an auditor. So in a limited liability partnership, it means you won't be able to bear this liability just alone as a partner, but it can actually be borne by the partnership itself. By the partnership itself. So because it has the elements of a company, then that liability will be paid by the audit firm. By the audit firm. You are 3 partners. You are the one of you as a partner, you signed a report, then kimeumana. You signed a report, then kimeumana. Hiyo report ulisign, ulisema tu vitu zako. Then a liability has arisen. Kuna watu ulidanganya, kuna kampuni inafanya vizuri, or there's a company having to perform so well. The financial statements have actually been fairly presented. Then a liability arises. Those persons, in this case, who are duped by your report, they go to the court. You are penalized or you are fined as a partner. So it means you are the one who signed the audit report, and therefore individually you should end up having to suffer. But if it happens, it operates as an LLP. There are those elements of an LLP or a limited liability partnership that are like similar to a company, where we're having to talk about in a company, we can have a limited liability, where you as an individual partner in that audit firm, you won't suffer alone, but that liability will be borne by the entire audit firm. So it operates as an LLP. So special kind of partnerships that professional firms operate in that way. So these special kind of partnerships, they have some features or elements of a company. Key one amongst we're having to talk about is in a situation where we now have a partnership where there's a limited liability of the partners. There's a limited liability of the partners. But for a normal partnership, which is not an LLP, there's no aspect of limited liability because there's no principle of separate legal entity. There's no aspect of limited liability. If a liability arises, then the personal properties of the individual partners can end up having to be attached. But in a special partnership, LLP, that cannot happen. So it will just be up to the set extent what you've actually been able to put in as what? Maybe the capital in the partnership, and any other liability has to be borne by the partnership itself. So you as an individual partner in that audit firm, you won't suffer by bringing in your properties. The firm itself will be able to bear all the liabilities because you've already been able to contribute capital inside that particular LLP, So they are called LLPs, LLPs, limited liability partnerships. So special kind of partnerships that have some features or elements of a company. Key one, where there's a limited liability of the partners in that kind of a partnership. And professional firms like audit firms or lawyers, nowadays, they like having to operate like that. So that a liability cannot actually end up having to befall you as an individual partner entirely. So part of them might end up having to be borne by the partnership itself. So auditing firms cannot be formed by one person. No, we haven't said that. So you can form. If you wish to form one, Paula, you can form. But now you'll operate as a company. You'll operate as a company. So we can go to the next one, which is actually what? Cooperative societies. We can go to cooperative societies. We can go to cooperative societies. We can go to cooperative societies. Cooperative societies is the last one that you're going to look at. Cooperative societies. So cooperative societies. So what are some of the features of a cooperative society? Number one, regulated by the Cooperative Societies Act. By the Societies Act. Regulated by the Corp Societies Act. Number two, when you talk about cooperative societies, so let me just list the features, then I'll explain to you. With cooperative societies, primary objective is to serve the members. Primary objective is to serve the members. Another key feature about cooperative societies that you have to take note of, they are formed majorly by persons of the same profession. Same trade or profession. Same trade or profession. Same trade or profession. Number 4, key feature. Their source of capital is membership fee. Source of capital. Their source of capital is membership fee. Membership fee. Membership fee. Donor funding. Donor funding. Or what we refer to as government grants. Government grants. Government grants. We have what we refer to as government grants. Their membership is usually confined majorly in a specific area. Majorly membership is confined. Majorly membership is confined in a specific area, a specified area or region, specified region or area, Number six. Another feature is that their source of capital, that is membership fee. The membership fee is usually uniform. Membership fee is uniform. Membership fee is uniform. Number 7, key feature about cooperative societies. They are managed by a management committee. They are managed by a management committee. They are managed by a management committee. Committee drawn from the members. Committee drawn from members. Drawn from the members. They are managed by a management committee drawn from the members. They usually managed by a management committee drawn from the members. They are usually managed by a management committee drawn from the members. Drawn from the members. Drawn from the members. Then of course, these ones you can't actually end up having to say they are not a separate legal entity. They exist separately from the members. These ones exist separately from the members. They exist separately from the members. So they exist separately from the members. This happens to be like part of the key features we can talk about regarding what cooperative societies. So we can talk about them having to be regulated by cooperative societies, the Coop Societies Act. Ideally, when you talk about a cooperative society, you know about them. So they are usually or majorly formed by persons of the same profession or maybe trade. And eventually, they likely end up having to operate like what? Circles. Because you can be able to see, we are having to say their primary objective is to serve what? Members. Is to serve or support the members. In terms of loaning, in terms of maybe the kind of activity they're having to be involved in, they can actually be supported. If they are farmers, they can be able to get farm inputs at a very subsidized price. It can be tea farmers, maybe at Kericho. So for them to be able to undertake adequate tea farming, they can come together and form a cooperative society and end up having to form a cooperative society. Once they form the cooperative society, then they can easily get farm inputs like maybe fertilizer, then they distribute to the members. If they get it as a cooperative society, they might get it at a very cheaper price. Then in this case, distribute to what? To the farmers. The main purpose is having to do what? Serve the members. Through the cooperative society, then this Coop society can be able to collect all the tea of the tea farmers who are members, then they sell to what? The manufacturers, so maybe the factories. Then eventually they are paid the money, then the money is actually distributed amongst what? The members, or in this case, what? The members of that Coop society. Alternatively, they can end up having to benefit the members by even by themselves setting up a factory. If they have adequate resources, or the government can be able to provide support, they can be able to set up their own factory. Other than these tea farmers having to walk a very long distance, or so many kilometers, taking their tea to the buying centers, they can themselves set up what? A factory or manufacturing plant. Then they can be able to manufacture the tea and eventually sell it abroad, export it abroad, get the money, then eventually distribute amongst what? The members. That's what we mean by a cooperative society. So you're having to say eventually some of them will end up having to operate as circles. Then they'll give loans to the members and support them in their activities. So if they need a loan, they do like that. So if they make their contributions like that, then eventually they can be able to get what? A loan. What you realize with these kind of societies, is that majorly, not always, but majorly, membership is usually drawn from a very specific area. Majorly also, they are formed by a person of the same trade or profession. That's why if you look at our circles, most of the circles, if you realize how they started, Mwalimu Sacco, you can see they are persons of the same trade. Muhasibu Sacco, persons of the same trade, same profession. There's something in this case they would like to fulfill for the members, to serve the members by having to ensure maybe they get what? Loans and support themselves. There are so many of them we can talk about. Huko mashinani. If you go to Murang'a, they are there for coffee farmers. If you go to Kericho, they are there for tea farmers. If you go where? To Limuru, they are there for dairy farmers. So they have set up what? Their own co-op society. So they eventually maybe collect all the milk in that area of the members. Then they sell them to KCC. Then KCC brings the money, they distribute amongst the members. That's how cooperative societies end up having to operate. And that's what I've been able to list here as what? As futures. So don't start having to wonder, what is Mwalimu having to say co-op society? That's what we mean by a co-op society. So they are regulated by the Cooperative Societies Act. But you see the side of the company, they are regulated by what? The Companies Act. Number two, their primary objective, first of all, is to serve the members. They might be involved in some business activities, like what you're having to say, that they set up their own factory to manufacture the tea, then in this case, end up having to sell it, they now give the money to the members. But first of all, they'll be able to ensure they have satisfied the needs of the members. They serve the members. Any business activity will come in as a secondary objective. So for them, their primary objective is to serve the members. Profit making is just a secondary objective. If their main purpose is to ensure farmers get farm inputs at a very cheaper price, they'll first of all fulfill that. Profit making for them will just come in as a secondary objective. But what about companies? Primary objective is to make profits. Here, primary objective, serve members. They are formed majorly by persons of the same what? Trade, or in this case, what maybe profession. But that doesn't happen in case of a company. So a company can just be formed by anyone. You're not under mandate for all of you to be accountants to form a company or become members or shareholders in a company. Their source of capital major, you likely end up having to be called upon. You contribute a membership fee when you are joining. Then the government usually supports them. And in fact, in Kenya, we do have a ministry purposely set to support what? The co-op societies. It is headed by Oparanya. Oparanya is the head of that ministry. He supports activities regarding what? Cooperative societies or the cooperative movement. So every year, there's a budget set aside for some money that has to go into those kind of activities or supporting what? Cooperative societies. So they can get membership fee, they can get donor funding, they can get government grants. That happens to be their major source of capital. What about a company? Share capital, debt capital. Number 5, majorly membership is confined in a specified area or maybe region. If it is Murang'a, coffee farmers in Murang'a. If it is tea farmers in Kericho, tea farmers in Kericho. Majorly that is what will end up having to happen. Not in all of them, but majority of the cooperative societies. Membership is usually from that area to benefit members of that area. But what about a company? Membership can be drawn from a very wide area, the entire country. We might end up having to be shareholders where? At Safaricom. So you can see that is a difference. Then membership fee is usually uniform, or we say it is homogeneous. The source of capital in terms of membership fee is uniform or homogeneous. What will happen here? They'll say for you to become a member, you have to contribute 2,000. And that becomes uniform for each and every person who's having to join us as a member. But if you want to be a shareholder in a company, you're not limited. We might realize our friend Rosemary is having shares worth 10 million. Our other friend is having shares how much? Maybe 30 million, so like that. So it is heterogeneous. In the case of a company, the source of capital is heterogeneous. In the case of a co-op society, the source of capital is uniform because the membership fee is just uniform for every person. Management, how do we manage a co-op society? We'll just come up with a management committee. It is normally drawn from the members themselves. If it's a circle, for example, they'll say, we need to set up a management committee. They'll call upon people to put in their submissions. They'll be elected as what? As the members of that management committee. In the case of a company, members or shareholders appoint Directors, you can see that is a difference. In the case of a corp society, it is managed by a management committee drawn from the members of the society itself. While in this case, in the case of a company, managed by directors who are normally appointed, maybe dependent upon their expertise, by the shareholders or members of the company. Another thing in this case you realize about cooperative societies, of course, you're having to say here, they first of all fulfill the needs of, in this case, what? Members. But through the cooperative movement, you realize they might even come up with what? Other activities or social amenities that might even support the entire community. They might even set up what? A hospital or maybe a clinic, because they have realized their members are suffering. Their members are suffering. When they come up with that clinic, ideally, if it's a school, maybe a clinic, it won't just serve the members of the corp society. Even those who are not members will end up having to benefit. So we can say the activities involved in by corp societies go to the extent of supporting the entire community or maybe society. The entire community or maybe society. So they'll in this case improve the livelihood of those who are the members and the livelihood of those who are not even members through such kind of what? Activities or maybe amenities that they might end up having to set up. That's what we mean by a cooperative society. And those happens to be part of the differences that can end up having to arise when you talk about a cooperative society and a company. This one hasn't been tested for over the last like 10 years. So I don't know whether they'll surprise us and test this particular sitting, but it is in the syllabus. So it is in the syllabus, but it hasn't been tested for a very long time. Cooperative societies and a company, the comparison. Rarely they have tested it. But you have to take note of that, take note of that, take note of that, take note of that. So that's the end of that particular area. So I want us we take a break. When we come back, I want us to now look at the next topic. We start looking at the next topic. The next topic, I want us to look at the next topic. When we come back, I want us to start looking at the next topic, which is topic 2. So after that break, we need to start seeing what is happening in topic 2. You can write topic 2, which is actually known as what? Formation of companies. Formation of companies. Formation of companies. It is known as formation of companies. It is known as formation of companies. So let's take a break of like 5 minutes. Yes, we can continue. So confirm there whether we can proceed. So indicate there on the chat whether we can continue. Indicate there on the chat whether we can continue. Benedict, Vincent, Benedict, I can see Brian says yes, and Korogosi says yes. Mering Amos says yes. So we can proceed there. So topic number 2, formation of companies. Under this topic, you're going to understand what is incorporation. What is incorporation? Incorporation. What is incorporation or promotion of a company? What is incorporation or promotion of a company? Also, we'll get to understand who is a promoter. Who is a promoter? Who is a promoter? And the duties of a promoter. Who is a promoter? And the duties of a promoter. Then also we'll get to understand the duty of the promoter. The duty of the promoter. The duty to act. The duty, we'll get to delve deeper further regarding the duty to act. The duty to act with utmost. The duty to act with the utmost good faith. Utmost good faith. Duty of utmost good faith. We look at the duty to act with the utmost. Of course, the promoter has so many duties, but there's this one that is key that we look at it. Why is it that he has to act with the utmost good faith? Utmost good faith. Utmost good faith. We'll also look at the remuneration. The remuneration of a promoter. Remuneration of a promoter. The remuneration of a promoter or compensation of a promoter for his role as a promoter. We look at the pre-incorporation contract. The pre-incorporation contract. The pre-incorporation, we look at pre-incorporation contract, the pre-incorporation contracts, pre-incorporation contracts, and of course the rules. So here we'll majorly focus on the rules that govern what we refer to as pre-incorporation contracts. We look at how the promoter, we will look at how the promoter can avoid, liability, how the promoter can avoid liability on pre-incorporation contracts, how the promoter can avoid liability on pre-incorporation contracts. We'll also look at, there are 2 key documents when you're having to form a company. But before that, we would have already been able to look at the procedure. We look at the procedure of formation of companies. I'll explain to the procedure of formation of companies. Then, when you're forming a company, there are 2 key documents that are usually required. I'll also be able to delve deeper into them and explain to you what is contained in those documents. We have what we refer to as the memorandum of association. Then you have what we refer to as an articles of association. We have what we refer to as a memorandum of association, and you have what we refer to as what? An articles of association. Memorandum and articles of association. We'll also look at a key doctrine. We refer to it as what? The doctrine of constructive notice. We refer to it as the doctrine of constructive notice. Doctrine of constructive notice. Then last but not least, we will look at another very famous case law in company law. We refer to it as the Taquand case. The Taquand case or the rule in Royal British Bank versus Taquand. Royal British Bank versus Taquand. Rule in Royal British Bank versus Taquand. This is ideally what you're going to cover in this topic. So just on the topic itself is all about what happens regarding when a company is coming into existence. Remember we said that a company is a person, but in this case, it doesn't come into existence naturally like us human beings. There has to be a procedure to be undertaken. There has to be a process to be undertaken. That's ideally what you'll be able to understand under this particular topic of formation of companies. When you talk about formation of companies, the person who will undertake the step of having to ensure that a company has been formed as a business, has started having to exist as a separate legal entity, this person, we refer to him as a promoter. A promoter. This person, we refer to him as what? A promoter. In any case, anyone undertakes all the procedures necessary, the artificial procedures necessary to enable a company to come into existence as a business. That person, we refer to him as what? A promoter. What he would have been involved in, we refer to it as what? Promotion, or refer to it as what? Incorporation. So ideally, when you talk about promotion of a company, it is that process or procedures undertaken to set up a company to exist for the foreseeable future, or to exist as a going concern. That procedure, those procedures involved in having to set up a company to exist for the foreseeable future or as a going concern, we refer to it as promotion. The procedures undertaken to have a company exist for the foreseeable future or as a going concern, we call it promotion, or we can call it incorporation, or you can use the term formation of a company. The person who undertakes this procedure, we refer to him as a promoter. As a promoter. Now that you're talking about a process or procedures, what will be involved in these matters pertaining to promotion of a company? What will be involved in these matters pertaining to promotion or having to form a company? And therefore, we come now under what we refer to as what? The duties of a promoter. We come under now what we refer to as what? The duties of a promoter. We are having to say it is like a process. It is some procedures. But ideally, what is this promoter doing? For us to say the company is coming into what? Existence. Part of the key duties of a promoter, he will suggest, propose, what will be the name of the company. Maybe he'll end up having to say, we'll call it 𝐬𝐭𝐮𝐝 Limited. 𝐬𝐭𝐮𝐝 Limited. So like that. So he'll propose the name. He'll propose the name. That's why every company has a name. So he'll propose the name that you're going to form a company. So his company, what will be the name? That is part of what? The first very key duty. So proposition of the name of the company. Another duty is to formulate two key documents. We've been able to mention them here. Formulate two key documents. One of them is what we refer to as a memorandum of association. Another we refer to it as what? As an articles of association. Formulate two key documents that will enable the formation of the company. These key two documents, you can't end up having to form the company if the registered company hasn't seen those documents having to be provided. So we're having to say, number one, suggest, propose. What will be the name of the company? Number two, we're having to say, formulate the documents supporting or enabling formation of the company. One of them, we refer to it as a memorandum of association. Another one is an articles of association. Now the question you're asking yourself, what is a memorandum? What is this Mwalimu saying memorandum? What are those? What are those? What are those? What are those articles? What are those? What is a memorandum? A memorandum is a document explaining, elaborating more about the company to the outside world or to third parties outside there who might not in this case be so much interested with the internal affairs of the company. They would like to know more about the company. Which document can they be able to have a look at? They can look at what? The memorandum of association. What is the memorandum? A document simply having to explain, elaborate more about the company to the outside world. It'll have like the name clause, the objective clause. The name clause elaborates more about the name. The objective clause, the reason as to why in this case the company was actually formed. Share capital clause. It explains like what is the composition of the share capital of the company. Registered office clause. It explains like what is exactly the registered office of the company. The liability clause. It explains is the liability of the members limited or unlimited in this company. What is a memorandum? A document simply having to explain, elaborate more about the company to the outside world. What about that other one? Mwalimu has mentioned articles. And articles is like the constitution of the company. Is like the law governing the affairs of the company. It is a document containing the internal rules and regulations that will enable what? Different kind of procedures to be undertaken within the company. And therefore we'll have what we call what? An articles of association. We'll happen to delve deeper into these two documents. We look at them separately and delve deeper into them. But take note, part of the key procedures when the promoter is having to form a company, it is to formulate the memorandum, and the articles of association. Another duty, propose the location of the registered office of the company. Where will it be located? Knox. It will be Knox. Knox where? Which street? Or it will be 9. It will be 9. So propose the registered office of what? Of the company. Propose the registered office of the company. Another duty, propose or suggest the first directors of the company, the first auditors of the company, the first company secretary of the company. And in this case, also do what? Propose the bankers. Who will be in this case be what? Be the bankers of the company. Be the bankers of, in this case, what? The company. Bankers of the company. Another duty, enter into any agreement, contract, so far as it deems necessary to enable this company to be formed. He will be given that mandate. If there's actually any other contract or agreement he has to enter into to enable this company having to be formed, then that will be part of what? His duties. As he's having to do all these, the memorandums, entering into agreements or contracts to support formation, proposing the name, he is fully under mandate to ensure that he's doing all this with what we call what? Utmost good faith. What do we mean by utmost good faith here? Everything he's having to undertake during these procedures of having to form the company, it is for the best interest. Best interest. In short, that's what we mean by utmost good faith. Best interest of the company. Best interest of the company. He's not having to do it for his own personal interest. For his own personal interest. So he has to do it for the best interest of the company. He has to act with the utmost good faith. So he's under mandate to be undertaking this with the utmost good faith, or for the best interest overall of the company. Overall of the company. Like there's one duty you've been able to say. Enter into any agreement or contract so far as it is necessary to enable the company to be formed. Maybe in this case, the company has to have what? A location where maybe they want to set up what? Maybe the factory or something. So he might end up having to do what? Sell or dispose of his land to the company. Dispose of his land to the company. This land is supposed to go at a value of, maybe him as a promoter, he has sold it to the company. They will pay him once the company has been formed. This land is supposed to go for a value of 4 million. But because now in this case, he has seen an opportunity, the Kenyan way, someone has seen an opportunity. Instead of having to say the price of this land is actually 4 million, he says it is 12 million. He says it is 12 million. So that he can be able to just get cool extra 8 million. Cool extra 8 million. So he's not having to do it for the best interest of the company, because you can see the company would have actually suffered. He would have actually ended up having to sell this land to the company at a very exorbitant price, far much beyond the market price of land in that kind of allocation. If such is having to happen, you can see his interests. Are they really with the company? Are they really with the company? They're not actually with the company. He has actually failed on his duty of what? Utmost good faith. He has actually failed on his duty of utmost good faith, acting for the best interest of the company. And therefore, as just we're having to say, if it happens during this particular procedure of having to form the company or incorporate the company, the promoter has entered into an agreement or a contract to sell any property to the company, any property to the company, he has to do it in what? Utmost good faith or best interest of the company. Otherwise, there can be consequences or repercussions that can arise. For example, in that kind of a situation where he has failed to act with the utmost good faith, in a situation where he has dealt with the company, more so in a situation where we're having to say he has transferred or sold part of his properties to support or enable formation of the company, and he hasn't acted in good faith. He has maybe sold it at what? At an exorbitant price. If this happens, then maybe later on, after the company has been formed, it is discovered this happened. Overall, the company will make a conclusion. The person who incorporated as a company was not having to act in what? Good faith. The land we're having in this case to utilize, maybe to set up our factory, was actually sold at an exorbitant price, far much beyond the market price. So the company is allowed, is actually in this case allowed to undertake certain measures, like to recoup this amount that was in this case received in extra by the promoter, which is actually what? 8 million. Another alternative, they can actually end up having to, these extra amounts we refer to them as secret profits. So one of in this case, One of, in this case, the ways the company can be able to, for example, recover that amount, they can recover the secret profits, recover the secret profits. They can recover the secret profit that was actually made. The secret profit in this case was what? The extra 8 million. Number two, they can repudiate or cancel the contract. Repudiate or cancel the contract. Cancel the contract. They can cancel the contract and recover the purchase price. They can cancel the contract and recover the purchase price. Especially if it happens, maybe if that asset that was sold is no longer in existence within the company. Maybe it was a motor vehicle, so it has already been sold to another party. So it means they cannot go to that party and ask him, bring the car or bring the motor vehicle. We return it back to what? To, in this case, what? The promoter. So if that has happened, then they can be able to do what? Recover the secret profits. Already a third party has acquired the rights over the property. If a third party has acquired the rights over the property, it has been sold to another party, then they can just recover the secret what? Profits. But if it happens, the property is still within what? The premises of the company. They can cancel that contract and in this case, return back the asset and recover the purchase price. So cancel the contract of sale of the asset to the company and recover the purchase price. If already the rights under the asset have been acquired already by a third party, maybe the company was sold to by the promoter, they have already sold to another person. So they can't go ask him to bring, they'll just in this case call upon the promoter to bring back what? The secret profit that was in this case realized under that particular property. If it is still within the premises, then they can be able to cancel the contract, then recover the full purchase price of 12 million. Alternative number 3 or remedy number 3 that the company will have, they can sue the promoter in a court of law and recover any damages or losses that might have been suffered by the company during that situation or that circumstance where the promoter was having to sell an asset by failing to act in what? In good faith. Selling the asset to the company by failing to act in what? Good faith. So overall, what you're having to say, when the promoter is having to promote the company, if there's actually any contract that was entered into, maybe between the promoter and the company, like a sale of a property to the company, all that has to be done by acting in good faith or in the best interest of the company. Because if it happens, it is realized by the company that the promoter failed to act in good faith or best interest of the company has remedies. What are the remedies? If is a sale of an asset to the company, they can recover the secret profits that were made by the promoter. They are secret because now in this case, he failed to act in what? Good faith. He never revealed those profits. That in this case, of course, it is 4 million, but now in this case, I've ended up having to sell at what? 12. So they become secret because he has not actually revealed them. He was just doing it for his own what? Personal interest. He doesn't want the company to know. They become secret profits. And there are remedies for the company against the promoter. If it happens, he has made secret profits, and that is overall he has failed to act in good faith or best interest of the company. Number 1, recover the secret profits if the rights under the asset have already been acquired by a third party. Number 2, cancel the contract of sale of the property to the company and recover the full purchase price. Number 3, sue the promoter to recover any damages or losses that were suffered under that kind of a contract where he sold an asset to the company and made what? A secret profit. And made a secret profit. Remember that sometimes they end up having to test that, although it hasn't been tested for a very long time. It hasn't been tested for a very long time, so we don't know. Maybe they might test it or they might not actually end up having to test it. So there's this one here, remuneration of a promoter. You can see this promoter has done some work. He has proposed the name, he has drafted the memorandum, he has drafted what? The articles. He has actually been able to propose the registered office of the company. He has actually been able to propose who will be the first directors, who will be the first auditors. Amefanya kakazi hu promoter. Amefanya kakazi hu promoter. So what happens in the case of a company? How do they compensate him? How do they compensate him? How do they end up having to compensate him? How do they end up having to compensate him? So what about the prospectus? It is correct. Prospectus is correct. So if it happens, he's forming what we call a public company. Our friend is asking about a prospectus. He's forming a public company. Public companies can invite, remember we said they can invite members of the public to buy into their shares. So to invite members of the public to buy into the shares of a public company, then it is normally through a special document we call what? A prospectus. So part of the other duties we can be able to mention, although it is not in all the companies, it only happens if he's having to form what? A public company. So if the promoter is forming a public company, he can prepare that prospectus, which is a notice or advertisement, inviting people to buy the shares of the company. And of course, this prospectus has a lot of contents. We will learn more about it in our topic of share capital. So if it's a prospectus, it will happen in a situation where he's having to form what? A public company. A public company. So it is correct. It is correct, our friend. This is our friend who? 𝐿𝐴𝐵𝐿. 𝐿𝐴𝐵𝐿, it is correct. That is actually what? Correct. That is correct. If he's forming a public company, he's the one who will be under mandate. But when we'll be looking at the topic of share capital, we'll see these prospectus can be prepared by directors in an already existing company. It can be prepared by the promoter himself on the formation of the company. Or it can be prepared by involving other experts, like maybe auditors. But that is an situation where we have already been able to form the company. But if you are forming the company initially, then you can also be able to do what? Prepare the prospectus. He can actually be able to prepare the prospectus. So once as we wind up by having to look at what? The remuneration of a promoter. The remuneration of a promoter. There's no any provision or any law having to indicate that for all these we've been able to mention, the promoter will be able to do. He has to be compensated. There's no any law or any provision under any act having to indicate that all these that the promoter has actually been able to do, he has to be paid or be compensated. But companies will devise a number of ways as to how they can compensate the promoter. Wanaweza rudisha mkono. They can devise a number of ways as to how they can do it, rudisha mkono. How can they end up having to remunerate the promoter? Number one, they can actually give him free shares in the company. Once it has been formed, free shares, 100,000 shares. You did a lot of work. I say you did a lot of work. I say you did a lot of work. So we are going to give you some free shares. So they would have remunerated him. Another way they can compensate him or remunerate him is to allow him, of course, to buy the shares, not just to give him free, allow him to buy the shares, but for him, his shares will be discounted. So allowed to buy the shares of the company at a discounted price. That is what? Remuneration number 2. Number 3, this guy, we cannot in this case just leave him like that. At least we can give him a position in the company. We can give him a position in the company. He can be appointed amongst the first directors of the company. That is a way they can compensate him. Another way, let's assume he is forming this 𝐿𝐴𝐵𝐿's company. He is forming this 𝐿𝐴𝐵𝐿's company, public company. Another way is forming this 𝐿𝐴𝐵𝐿's company, which is a public company. And he has prepared a prospectus. He has enabled the shares to be sold. He has enabled the shares to be sold because he's the one who prepared that prospectus, convinced people to buy shares in the company on the formation of the company. We can't just leave him like that. We can give him a commission. We can give him a commission. So commission on shares sold on the formation of the company. If it happens, it is actually what? A public company. If it happens, it is actually what? A public company. Another way, this promoter, of course, we know that in this case, he's doing some business. He's in this case involved in selling properties, assets. He does a lot of business. He's a jack of all trades. We can, in this case, of course, allow him to sell assets to the company. But now, in this case, we'll end up having to tell him, you have to do what? Reveal any profits you made. Let them not, in this case, end up having to be secret profits because you would have failed on having to act at what? Under what? Utmost good faith. So they can allow him to sell what? Properties to the company. Sell properties to the company. So long as he ends up having to do what? Reveal the profits. Failure to which they can be taken to be secret profits. And therefore, there can be these remedies arising for the company. Another way we can remunerate. After the company has been formed, after company ishakuwa mtu, after the company has become a person, and therefore it can now be able to contract, we can now formally enter into an agreement and now tell the promoter, hey, hapo nyuma maze, there's in this case some work that you actually did for us. You formed us as a company. Now we can draft a contract and be able to agree how much are we going to pay you. So after the company has been formed, he can now formally enter into a contract to be compensated for the work he did as what? As a promoter. Ways as to how the promoter can be remunerated. Free shares, shares at a discount, commission on shares, sell properties to the company, so long as it reveals the profits, Also, in this case, you're having to say, after formation, he might actually end up having to be formally be compensated or be paid by the company for the work he has actually been able to do as a promoter of the company, as a promoter of the company, as a promoter of the company. So today, we are going to end there. So in our next class, we'll likely be able to pick up from here, and we'll be able to look at, before we start this class, I look at a number of past paper questions, because today I haven't looked at a past paper question. So we look at a number of them regarding the areas we've already covered. So these ones, and the ones for the other ones, the ones for the first topic, the ones for the nature. We'll also look at a number of questions, but I'll be able to pick up from here, moving like this until we finish that topic. Any question you might be having, you can actually ask before we say hooray. Before we say hooray to this class. What is the main difference between a prospectus and a memorandum of association? Very big difference. They are not even related. They are not sisters and brothers at all. They are not sisters and brothers at all. Very big difference. Very big difference. So our prospectus will get to learn more about it in share capital. In share capital. So they are very different. So you can just be patient. When you start learning about memorandum of association, be very keen. Then when you go to the topic of share capital, also be very keen. But just to be able to give you a small difference, I won't delve deeper into it because there are a lot of things actually even involved under prospectus or memorandum. A prospectus is a notice or advertisement inviting people to buy the shares of the company. A prospectus is a notice or advertisement inviting people to buy the shares of the company. A memorandum is a document explaining more about the company to the outside world. A memorandum is a document explaining more about the company to the outside world. Part of the contents: name clause, registered office clause, objective clause, liability clause. A memorandum explains more about the company to the outside world. A prospectus is a notice, advertisement, inviting people to buy the shares of the company. So when you go to that topic of share capital, we will look at the contents of this one. When we come here under memorandum, we look at the contents of this one. So they are very different. Not even sister and brother. Very different. Very different. So hope you've gotten the point. Any other question? Any other question before we say hooray? If there isn't, then I think let me wish you a good night. Thank you so much for having been able to join our today's class. See you later. We'll meet on Monday. We'll meet on Monday.